first rates then on your screen so far, defending the 19,500 print, but yes, a 0.5% dip. That's pretty much par for the course. The market breadth as well is a little bit challenged this morning, although you are seeing a relative outperformance as opposed to what's happening within the large caps from the broader end of the market. The Nifty bank also starts off a little bit softish in trade, but first let's start by talking about what's happening within the FMCG pack, because those are the big giants which came out with their numbers post-market hours. That's Unilever in trade for you. The numbers were largely above estimates to a little bit in line. The margins have actually risen by about 690 basis points. But no, you're not seeing much excitement on Unilever. 2508 is where that stock is. What about ITC? That was definitely a better performance. Healthy Q2 internals, cigarette volumes were a beat at about 6%. FMCG revenues as well showed good growth. And of course, the hotel segment, because of its low base on a year-on-year basis, that was also quite a bit of jump up. But no, not much excitement either on ITC. 448, so pretty lukewarm response to its numbers. Jindal Stainless, the Q2 numbers have been in line. Signed, their EBIT margins have come in flattish on a sequential basis, but the EBIT has risen about almost 5%. Metro Brands, we were just chatting with the management. EBITDA has jumped up about 5.6%, revenue uptick of about 17%. Very marginal move coming in there from Metro Brands as well. And then, of course, I want to check in on what HUL is up to also, because the Q2 numbers look a little bit below estimates to in line. HUL, though, starts off flattish in trade. Emphasis also came out with its numbers. The constant currency revenue has been flat. Deal wins at about $255 million odd, 1% higher for Emphasis as we speak. And then UBL also came out with their numbers. The numbers, of course, are a little bit below estimates, but UBL has gapped up 3.25% there. Voltas, let's check in on that also, because there has been quite a bit of margin pressure. EBITDA has come in down by about 30%. Voltas down about 1.25% as we speak. And Tata Communications also came out with their numbers. Again, the numbers haven't matched up to what the street was expecting. 2% lower for Tata Com as we speak right now. What's Zomato up to? You just had that block deal take place. And then, of course, the Blinkit performance as well. Zomato has covered its losses. 112 is where that stock is. Also want to check in for a follow-through on a Hero MotoCorp, on a Bajaj Auto and an LTIM. And after that big breakout in most of these names, you're not quite seeing a follow-through come by, at least not on Hero MotoCorp. Bajaj Auto starts off flat. And LTIM sees some more uptick of about almost 0.5%. Actually, it's not all that bad. We're skirting around the 19,550 mark, Kunal, and a fairly resilient broader market.
Absolutely. I think, so the indices are doing one thing altogether, but the broader market, the opportunity to trade is also pretty much high. The stocks are seeing a follow-through even after a breakout or, positive close, maybe yesterday or day before. So I think that's a very good sign that the market breadth is still very, positive as such. So I would probably be looking out for more mid-cap names and, smaller cap stocks. Paytm is something which looks attractive as an opening trade. The stock is trading at 955, 960 odd mark. It's confirmed a swing breakout on the short-term charts. Would be something which I'll keep an eye on, especially on the opening trade.
All right, that's the view coming in on Paytm. Meantime, taking a look at the overall market move this morning, Naresh, what are your key takeaways with the fact that we are around the 19,550 mark, and what would be the first trade that you punch in?
So the key takeaways, we continue to see broader outperformance. The Nifty small cap 100 is just 70 points away from a new all-time high. It did hit it 2 days back, so we are not seeing much of a correction in the broader markets. So time to remain stock specific till the time we don't break 19,300. On the stock side, ACC looks like a good risk reward trade here at 2020, 2030.
Okay, Kunal, Naresh, we'll see you again later on in this show. So not looking all that bad given the kind of jitters that you were seeing from across the globe, given the fact that you had an elevated yield at 5% for the first time since 2007 and all that hawkish Fed commentary. We're not looking all that bad at 19,557. Of course, remains to be seen whether we stay put at these levels for the better part of today's trading session or not. For now, at least, the start has been good. Nilesh Shah from Kotak AMC then joins in on the show right now. Nilesh, hi, good morning. Good to have you on the show. And Nimesh, amidst all this gloom and doom and the kind of hawkish Fed commentary, especially that we had overnight, does it surprise you, the India resilience that we are seeing?
Undoubtedly, amidst the barrage of bad news, the markets are holding on quite nicely. And that's truly a confidence on long-term India growth story. I think as of today, both locally and globally, there are more investors who are waiting for corrections to buy, and hence the strength of the market is visible.
Absolutely. But will that correction come or not? Because that doesn't seem to be the case. I mean, amidst all the hawkish Fed commentary, amidst the yield spike, I mean, one would logically derive that that spells bad news for equities. You're going to see a flight of flows out of India, which we are seeing because what we've done from the 20,000 peak, FIIs haven't participated in India equity markets. They've been sellers throughout. But the resilient DIIs, they are the ones which are actually keeping the markets afloat.
So, Alisha, a couple of things. In 2007-8, 10-year US yield was 4.5%. 10-year India yield was 495, 45 basis point gap. And we had received $100 billion in terms of capital flows, both portfolio and foreign direct investment put together. We all know the 2008 crisis was more driven by subprime than anything locally. So in the past, we have seen far more tighter and far more narrower gap between US yield and India yield, and yet received the flows. Can this repeat in 2023? Second, it's not the domestic institutional investors' money which is keeping the market afloat. I think it is the confidence of domestic institutional investors on India Inc. and long-term India growth story which is keeping the market afloat. And my feeling is that foreign portfolio investors also might be tactically selling because of the global bad news from oil to US interest rates to Middle East. But in the end, they will also be a buyer at the lower prices. I doubt if they will be selling like they sold during March 20 without any price limit. Today they are selling undoubtedly, but they are selling with a very, very tighter price limit. And they will be looking to buy back those things if it's available at lower prices over a period of time.
When you dissect the market construct, Nilesh, there's a clear disconnect between what the large caps are up to and the kind of boom and big bull run which is currently taking place within the mid and the small caps, right? It's pretty much undeterred. Do you think this disconnect is here to stay for a while?
Frankly speaking, valuations eventually prevail. Time and again, history has taught us that if prices run up ahead of fundamentals, eventually either they have to consolidate or correct so that fundamentals can catch up with them. So my feeling is that this disconnect between large, mid, small and micro cap is not likely to last longer. Eventually fundamentals will prevail. Large cap will trade at a premium valuation to mid, small and micro cap. They can't trade at a discount for long.
Speaking of that valuation really catching up, Nilesh, I would like to get in your take on the FMCG space as a whole because while they have alluded to the fact that there's cautious optimism, rural recovery is happening, but it's gradual, the valuations that some of these companies are commanding seems to be a little bit out of whack, if you will.
So a large part of FMCG is witnessing time correction. The volume growth led by rural market has been fairly poor, and that's reflected into the earnings growth. In FMCG sector, corrections in terms of price generally doesn't happen because there is very, very limited supply. and the return on equity for this FMCG consumer company continues to remain strong. And more importantly, in a market like India, if not this quarter, next quarter, hope is always alive. So if you see the commentary of most FMCG company, they are looking forward positively to the festival season that has already begun. And they are hopeful that the initial trend which we have witnessed in billion dollar e-com days, that should translate into festival season buying running from Dasera to Christmas. So lack of supply, better ROE, and always the hope for the next quarter, that generally results into time correction in consumer stock rather than price correction.
Okay, fair enough. That's the word on the FMCG space. And what about when it comes to the compounding story within financials? Do you think that the leadership will definitely be within some of the marquee private sector names?
Undoubtedly, yes. No doubt that PSU banks have done extremely well from a price performance point of view in last 1.5 years. Their results have been fairly positive with the shift happening from losses to profit. But eventually, if you look at the valuation gap between private banks and PSU banks today, that has narrowed down significantly compared to historical averages. And from a growth point of view, from a sustainable growth point of view, I think investors will put money more on private sector at this valuation than public sector banks.
Nilesh, as a theme, you think premiumization and the aspirational India is going to continue and is here to stay? And, across sectors, we've seen that, be it cars, be it, homes, be it clothes or shoes or anything have you. It is the premiumization trend, which is pretty much at play across the board. Do you think that as a story is here to stay? Or do you think as an equity investor, what makes more sense is to perhaps bet in on some of the bottom-up stories, the rural focus plays, the tier 2 and tier 3 cities, which are currently in a slump, but perhaps scope of a higher alpha generation there?
So, Aisha, tier 2 and tier 3 cities are equally aspirational. People staying in tier 2 and tier 3 cities spend probably more time on mobile, and they are more up to date about what's happening globally. And they also have same aspiration as tier 1 towns. If we see India broadly, 1% of Indians enjoy lifestyle of French citizens. About 27% of Indians enjoy lifestyle of Indonesian citizens. And rest, 70% plus, are living sub-Saharan Africa level. Now, you have companies which are targeting the super luxury end. Very few Indian companies are there. There are companies which is targeting this 27% middle Indonesian group, Indonesian living standard. That's premium companies. And then there are companies which is targeting the mass market at the African standard of living. There is a constant upgradation from African standard of living to Indonesian standard of living to French standard of living in India. As an investor, you have opportunity in all three: premiumization, mass market, and super luxury. All three options are available in India. And as an investor, we'll have to keep our eyes open. As of today, because of the post-COVID consumption distribution, premium markets or premium products have done well, but it's just a question of time before the mass market products also starts doing well.
Nilesh, always a pleasure interacting with you. Thank you so much for giving us a lot more clarity on your market perspective as well as your view on the liquidity situation, global events and sectors. A quick check-in, we're at 19,577. You've got the Sensex down about 127 points, HUL, ITC, DV's Labs, the top drags. We'll take a very quick break, but don't go anywhere because we've got a very special interaction. The Managing Director and CEO of IndusInd Bank joining in on the channel to talk about the outlook on margins, implications of an elevated rate regime, as well as what the view is on their corporate slippages and more. Thanks for staying on with us. Just want to mark then some of the newsmakers in today's trading session. When it comes to earnings, we'll be watching out today from the Nifty 50 space for JSW Steel that will be coming out with its quarterly performance. There's also Paytm, something like Hindustan Zinc, Suntech Realty, Central Bank of India. All of those candidates will be coming out with their quarterly performance, so a close eye on these candidates. What's United Breweries up to? It was a margin expansion that they witnessed in this quarter. Just pull up some of these stocks. United Breweries, a 12% growth as well in their revenues at about 1,088 crore rupees. You've also got something like a Scient, that's another result candidate where you saw the profits come in higher by about 6%. Sagar Cement, a quick look at that stock because you had the losses this time around that expanded. But despite that, and the fact that that's been the only disappointment, stand corrected, sorry, 8.4 crore loss versus a 37 crore loss. So the losses have narrowed. There's been margin expansion and revenues as well have grown. But let's hear it out then as we wait by for the interview of IndusInd Bank to kickstart. For the word coming in from Nilesh Shah of Envision Capital, because he talks about his view on some of his top sectoral bets.
Of course, we continue to hold a relatively a focused portfolio, but it's a portfolio across sectors. And we have been liking names around capital goods, around defense, around auto components, the tier 2 banks, very specialized players in the financial space, which is online broking, online insurance. These are the kind of businesses that we have been owning. Also, our exposure to alcoholic beverages, we think that's a standout sector from a 5 to 10 year perspective. So that's the space that we have been kind of very, very positive about. Most recently, though, a lot of our new investments have been into, more the technology space. I have earlier talked about the exposure that we have had to MapMyIndia, which is C Info Systems. NewGen is a company that we have liked and we've owned. They came out with some stellar numbers. One of our most recent additions has been a small IT services company called Datamatics. We clearly believe that in the case of Datamatics, they seem to be on a path of higher growth. They have reorganized their businesses, largely focused around digital and artificial intelligence, which I think will provide strong tailwinds for them to grow at an industry-beating pace. They probably still have some bit of margins to expand. They're trying to build an interesting products portfolio, which might kind of result into slightly non-linear growth going forward. And valuations are attractive. It probably trades in mid-teens in terms of trailing earnings basis. So I clearly believe that there are a whole bunch of sectors which we've continued to kind of be very positive about. But off late, it's just coincidental that some of our most recent investments continue to be around the technology space.
We had a conversation, Nilesh, which was centered around the fact that you need to buy specialized IT companies. I mean, you buy a SaaS company, you buy a company which essentially is giving more services rather than just IT services. So if that theme has to be applied, one is Datamatics, what else?
Datamatics is there. NewGen is there. I think that's again, they announced their results very recently and they came out with some stellar numbers, business growing like kind of in the 20s, which I think is quite phenomenal. We continue to like LTTS, though they have cut the revenue guidance, but I still believe that in this current environment, if a company is talking of growing at 17-18%, which is high teens, and sustaining margins at 18% in terms of EBIT margins, and it's got a phenomenal size. I mean, it's now almost a 45,000 crore market cap company. So to that extent, it's not like kind of some small company out there. These are the kind of spaces. If I look at each of these companies, they represent very specialized space. I mean, L&T is basically an exposure to the ER&D space. They keep working on software-defined vehicles, the whole transportation, mobility space, semicon. That's the kind of space that they've focused quite a lot on. NewGen is again a very specialized products company focused more on the BFSI space, largely focused on India and Asia, but now trying to kind of make a dent or a headway into the US and Europe markets, which creates solid tailwinds. They seem to have a lot of wind in the tail, wind on the back, which is helping them to grow. So these are some really nice kind of opportunities which are there. And on top of that, MapMyIndia, which is more a domestic business, but clearly like the business that they run in terms of digital mapping solutions, in terms of IoT-led navigation solutions, artificial intelligence, drones technology for the future. The number of use cases which they can have probably can be quite phenomenal. So it's an opportunity which I think is like kind of probably spans across the next 5-10 years. Obviously, each of these businesses runs risks of competition or disruption and volatility in the external environment. These are the kind of risks and challenges which most businesses do face. I don't think there are exceptions to that. But on the whole, on the balance, I think these are nice businesses to own from a medium to long-term perspective.
Between 1st of Jan and 18th of October, have your top 3 holdings or top 5 holdings changed?
Not very materially, Nikunj. Not very materially. I still think we continue to own, the likes of Radico Khaitan, Angel One, PB Fintech, Mahindra Holidays. These have been some of our leading holdings. And Polycab. These are some of our holdings which we have continued to own. And we have not made any material change in any of these holdings.
Okay, now liquor, or when it comes to buying the entire liquor space, some would say that, look, it's very simple. India will consume more. India will grow more. Per capita will grow. Now, that's a lovely macro thesis. But frankly, if I look at some of the liquor companies, they've had a lot of volatility in their numbers. They get impacted because of raw material. Growth is always in mid-teens. Even though we are looking at a complete change in terms of consumption pattern changes, market cap changes, and per capita changes, liquor companies are mediocre growth businesses. What gives you the conviction to buy a mediocre growth sector then?
So Nikunj, I think, and my view is slightly more long-term, that probably for the next 5 or 10 years, I see liquor companies being able to kind of grow at maybe 15 to 20% on an annualized basis. There could be a few years, few quarters maybe where the growth may.
And as promised now, over to Nikunj. He's currently in conversation with Sumant Katpalia,
whom I would be interviewing today, in a sense has really spearheaded this dramatic rate of change. He kept on working, he kept on under-committing, and now the bank is really delivering and firing full cylinders. So it gives me great pleasure now to bring on board Mr. Sumant Katpalia of IndusInd Bank. Fantastic to have you. Thank you for joining us.
Thank you so much, and thank you for your kind words.
Every time I come to your office, I can see the bulls and the lovely paintings on the wall. So, bulls on the wall really are a mascot of how good you're feeling about the world and how good you're feeling about India.
Yes, I think, in a very difficult macro and the world macro, I think India, it continues to outshine, and I believe it's just started. I think the next decade belongs to India, and I'm completely convinced that whatever our regulators and the ministry is doing will only fuel the growth in the Indian economy.
Let's talk about specifics of IndusInd Bank. If I take the clock back, let's say 5-6 quarters ago, IndusInd Bank was growing in mid-teens. Now you're growing in early 20s, much higher than the industry average. You're growing without raising capital. Your CASA is in place. So can I say that now the bank is firing full cylinders?
I think you have to see our growth and where the growth is coming from. I think we have domain specializations. So our 2 domains actually got subdued during the COVID crisis, which is the vehicle finance as well as the microfinance. And we were very conservative on that. I think they've come back with a very strong presence. And over a period of time, we've also diversified that book. So we are not now dependent on one asset to give us the business. There are 8 categories of vehicles. For example, car loans is 25% of that portfolio now in the vehicle category. If you look at microfinance, they're not dependent on JLG. 15% of the book comes from merchant acquiring business. So we've started to diversifying that businesses so that the cyclicality of that business continues to go off. On the diamond side, we've seen a reduction because the diamond industry is in a stress. So we do working capital. The book has reduced by 10 to 12%, and we are fine with it. So I think as long as we are in the businesses which are seeing growth, I think we are seeing growth. We've added new boosters to our growth. Mortgage businesses have come in. Affordable housing has come in. I think our consumer bank business has started firing on all cylinders, growing at 35 to 40%. So we've got a very good momentum in place, and I believe the bank can grow at the rate of 18 to 23% on a compounding basis.
And you see this kind of invisibility for 3 years or beyond 3 years?
So we always make a plan. We've made a plan for PC6, which is a 3-year plan. We believe that we should be growing at 18 to 23%. And in the first year, we're growing at 21%. So we are on the right side of the growth rather than on the left side of the growth.
And you see you could remain on the right side of the growth for next couple of years? Because
I think
18
so.
to 25, sir, there is a delta of 5%.
18 to 23,
18 to
and
23.
You're absolutely right. And I think we believe that with the type of domains which we have and the investments which we've done in our business, our growth should be upward of 20% on a compounding basis.
Okay. Now, if one looks at the nature of your book and the current credit cycle, 60% of your current book could be called as cyclical in nature. Car loans, microfinance loans. The fact you're growing, is this largely because of the tailwind of cyclicality in the economy, and that could come under a check?
So you're wrong. 34% of our book comes from microfinance and the 37% of our book. Microfinance and vehicle finance.
Okay.
On the vehicle finance, if you go back 5 years from now, our dependency was on the MHCV segment. Today we do LCV, we do utility vehicles. So our dependency on the MHCV is reduced. We added car loans, which is another 20%. Then we added tractors, where we have a 10% market share now. So we added new areas of business so that the business is not dependent on one area, but is dependent on multiple categories of vehicles. And that is what has stood us in this time. And I believe you would have seen it over the 8 quarters now. My CFD business or the vehicle finance business continues to grow. I also agree with you on the microfinance business that it becomes cyclical during certain times, and that is why we've started diversifying that business. And I believe in 2 years' time, you'll see only 60% of the microfinance business coming from the JLG. 40% will get into diversified into house improvements, merchant acquiring business, scooter loans, two-wheeler loans. So it's not going to be only dependent on a small category of vehicle, which is the JLG business.
Your ratios are currently very favorable on the capital side, and it's about 16% plus. So if I add the maths here, 20% growth with the ratio, with the capital adequacy buffer, which means that 20% growth is coming without any capital raise. Will that be a fair assessment?
So we've done our calculation. We are at 18.3% on the overall capital and 16.3% on the CET1. If your internal accruals are what we are, and if your ROAs are between 1.9 to 2.2, in my opinion, you should be able to grow for the next 4 to 7 quarters without raising any capital as of now. And our risk-weighted assets, which were at 2.69, have come down to 2.59. So as long as you're balancing your risk-weighted assets, you're using your capital judiciously, I think you should be fine.
If I take the clock back, the turnaround moment for IL&FS for IndusInd Bank, first the downturn happened because of IL&FS, then COVID happened. Then you were able to check your book and get the growth back. But the real growth has come back in last 4 to 5 quarters. So growth coming back is one trigger for IndusInd Bank. Now for next 3 years, which ratio would you be able to improve so that there is going to be visible change in your profitability?
So I think 3 areas where we think the cost of funds on the liability side, and you would see as and more we granularize our liabilities and we become more and more granular, I think our cost of deposits differential between the large banks and us will reduce, and that should give us a 20 to 30 basis points NIM expansion over a period of 2 years.
Irrespective of the interest rate cycle?
Yes, okay. Irrespective of the interest rate. Okay. Because we have a fixed rate book, 60%. So we will see that advantage coming through to us. Number 2, I think our provisions and we've said that our cost of credit is 110 to 130 basis points. I believe at some point it will settle at 90 to 110 basis points for us. And I think that is where this bank will settle down. Even if you will see that coming from the 4th quarter, our cost will be 100, but I'll add 20 basis points to the contingent provisions. So I think that advantage of the cost of credit you'll start seeing in our balance sheet as we move forward. So that's number 2. Number 3, I think in a declining interest rate scenario, and I think the accommodative stance sooner or later in 4 to 6 quarters will start coming in. And once it starts coming in, our book is very different. So if you look at it, we are naturally hedged, but 58% of our book is fixed rate and 42% is floating rate. And you will start seeing the advantage of a fixed rate book with the declining interest rate, and you will see NIMS expansion as a consequence of that. So one is the interest rate, the other is the book itself will start giving you the expansion. So I think our NIM over a period of 2 years should settle down between 4.3 to 4.5, which we've saying 4.1 to 4.3, should move by 20-25 basis points. I think a credit cost become at least 20 basis points down from where we are. And in my opinion, that will give the bank a 2% steady, 2 to 2.2% steady ROA as we go. And that will be a very granular, very well diversified business as we move along.
The 2% ROA is something which is actually enviable even for best of the banks. So I'm just going to hit the pause button here and summarize it for our viewers, and maybe we're getting this entire framework from you. I will not use the word guidance, but I will use the word indication. The indication from IndusInd Bank is the following, that credit growth will sustain in and around 20%. You are looking at credit cost coming down and it's coming down significantly in and around 1%, and ROA is moving above 2%.
Yes.
If these three factors come together, then FY25 and FY26, according to our estimates, are going to be bumper years for you.
Yes.
Is that a fair assessment?
You're absolutely right.
In
my opinion, don't rule out 24-25 also.
Okay. What is your definition of bumper? I have a definition of bumper. You have a definition of bumper.
My biggest is fortification of balance sheet is a bumper year.
Okay.
Where we believe that our granularity of deposits has improved to 50% as per Basel III LCR. That's the bumper year for me. Number two, our granularization of the asset book is complete, and I think our risk weight assets are in the range of 2.54 to 2.59. That's the best you can get in the industry on the asset side. Number three, our gross flows, which are a little higher than the industry today. I think we make sure that given the portfolio we have, we're not considered as a high risk, high return bank. We are considered as a moderate risk, high return bank. That's the value, because we will always operate in the deep rural areas where the risk is a little bit higher, but we want to be classified that this is a moderate risk. They manage the risk well, and they have enough contingency buffers to take care of any cyclicality in the risk cost as we move forward.
There are attrition issues, especially at entry level and mid-tier level, and that is an industry-wide phenomenon. I look at the annual reports of banks and I'm surprised, not shocked, surprised with the kind of attrition rates which are there. Is that a challenge for IndusInd Bank? Is that a challenge for the industry per se?
I think it's a challenge. I think we have to realize where are we going wrong. One is each one of us is hiring from each other.
Yeah.
And what we are doing, we're increasing salaries. And at the junior level, people just move for 10,000 rupees also. So I think the type of movement which we are seeing is very, very high. Second, I think all banks don't follow a principled approach of how you upgrade employees as they move along. And I think a sales guy remains a sales guy for 2 years and he loses interest. In my opinion, if you want to create a culture in an organization of this nature, I think you have to follow a public sector model. And I think the probationary officer concept in a public sector is a fantastic concept. In my view, our bank should hire about 3,000 to 5,000 employees. Maybe there will be 50% attrition in year one. But over a period of time, in 2 to 3 years, you will create a force, which is a force to be reckoned with. And at certain points, all your middle management and senior management comes from the probationary officer. That is a culture which you will create in the long run, and which is a very stable and a consistent culture in the organization. So I think we in the private sector banks need to look a bit inward and bit outward. Inward, how do we create opportunities for our people in different areas of a very different, and do continuums, which we call. We have, but I think we have to rigidly follow those continuums. Number two, I think you have to look outside and see there are very beautiful models of probationary officers where the attrition rates are 2%, 3%. Why can't this bank follow that model?
Are you working towards that?
Yes. And I believe that is where a little, you look at immediate cost. Immediate cost is not the issue. In the long run, the cost of attrition is higher than the front-end cost which you will take. And I think we are moving in that direction. I can assure you this is not a simple fix. It will take me 2 years. But in 2 years' time, this bank will have a very stable sales force, which is completely reliable, and the probationary officer route will actually make sure that the stability of our resources and the growth of our resources are taken care of.
You've consciously stayed a bank. If I look at some of your peers, the top 5 banks, they are now platforms, from insurance to mutual fund, from just about anything which will generate more fee-based income for them, they are present there. Have you consciously shied away? You did bid for example, the Citibank credit card, but you did not find the value at which your peers were bidding. So bottom line is, IndusInd Bank is perhaps the only large bank in India of its size, which is very unique and which is only focusing on banking. That's a good and a bad reputation to have.
So I tell you, you have to see at what time you want to do what. Unfortunately, we had a plan to get into para-banking and all these activities in 2018. But somehow the circumstances and the environment changed against us. And at that point, to go to the regulator and ask for an approval would not have been very nice, because you got to bring stability into your banking business. And that's your main line of business before you start doing any of these things. And I wanted to bring stability of our funding franchise and our asset franchise, give the comfort on our governance processes to the regulator before I said that let's step out and start doing things. As we do this, I'm still interested in a para-banking activities. I believe an AMC business and a brokerage business complements the wealth management business which we want to do. So we will continuously evaluate, and we think we are at an opportunist time right now, because I think savings will move into capital markets as and when we go. That banks should invest in these type of businesses, and we will find the right time. And I think in the next 2 years, you should start seeing us evaluating and proceeding in that direction.
There are 40 AMCs in India. Brokerage rates are coming down. Are these the good sectors you really want to get in, because competition is brutal?
It doesn't matter. You have to look at organic and inorganic ways to do this business. I think you have to decide what type of business model which you will create and what segments which you will enter into this business. So there's always an opportunity if you do it the right way. It's never going to be a cluttered market in India. There will be competitive intensity, but the market is so large and the growth is so humongous that everybody can have their share of pie in the business.
Do you worry about your market share movement in the banking business? Because that becomes a benchmark for everyone to judge that, one of the benchmarks is everybody judges a company's growth is what is happening to the sector and what is happening to their market share in the sector. Are you aiming at more profitable growth or more market share growth?
So different strokes for different folks. In the vehicle finance, in our domain specialization, we want to be number 1 or number 2. That gives us pricing power, and that gives us credit cost, stability. We've seen that over a period of time, that if we play the domain specialization and you're number 1 and number 2,
like in
diamonds,
like in diamonds.
It is a fantastic business for us, and they give you 3 to 4% ROE businesses. So that's we will continue to add 1 or 2 domain. In the long run, 55 to 60% of our business will come from domains. So where we are weak. However, having said that, you have to be in the top quartile in the return ratios, because if you are in these type of businesses and you're not in the top quartile, I think you will never be a business to be reckoned in, and the market will never give you the credit for that. In our opinion, you have to see how you mix and match both these events. So while you have to be a leader in the assets in which you do, where you have a right to win, you should play in assets where you have a right to win. In return ratios, you should always be in the top quartile of the business.
Markets are curious to know that when would the Hinduja family be increasing their stake in IndusInd Bank? Most of the necessary regulatory approvals are in place, and they've come, I think, 6 months ago. We've not heard from anything beyond that.
So I can't comment on that. There's an internal process of capital raising and the IPO happening in the promoter company, which is our IHL. When does that happen and how does it proceed? I think will happen. Having said that, since we are very well capitalized, we don't need the capital right now. Even if they get the approval for the 26% stake, I think it will depend on the bank when it wants to raise the capital. I would always want that if they get the approval, they should bring in the primary capital into the bank because it makes the fortification of the balance sheet much better. I will always want that.
So you don't need capital. And shareholders, they want Hinduja holding or promoter family, family holding to go higher. The only way out I could think of primary capital, or I could think of open market transaction, or they could increase their stake by the open market. So can that also be considered?
In my opinion, I think a very small portion they should consider, but I think more and more a promoter who has a long-term interest should always fortify the balance sheet. And I think there will be many opportunities. If I said that there is a fourth domain which is going to come in or a para-banking activity, that is an appropriate time for them to say, is there an inorganic route or an organic? And that is when the capital requirements come in. Not on the BAU business. I think we are very well served on the BAU business. Just increasing the capital is not going to help the bank.
It's going to bring the return ratios unnecessarily down only.
It doesn't make sense for them to bring the capital now.
Okay. So let's look at scenario number 2. Scenario number 1, you've shared with us the credit growth, the return ratios. Scenario number 2 is that the bank receives capital from the promoters. Now, if the capital comes in, the fourth scenario which you talk about, the acquisition route opens. What happens in scenario number 2? Let's say next 6 months or next 1 year, the capital comes in from the promoters. Then what happens in scenario number 2? Because that's a realistic scenario. We are talking about scenario number 1, which is on the table. But there is another possibility of scenario number 2, which could happen. So in scenario number 2, what happens to the progress and the curve of the bank's growth?
See, if we get into scenario number 2, I think para-banking will come in, and I think the bank becomes a conglomerate rather than a banking business, which is what you taught. And I think that's a very important vector for a bank. Take 2 years, 3 years, but it becomes that. I've always said that domain specializations is where we focused, and what differentiates this bank as a USP from other banks is that we are a large bank in the domain specializations.
Thanks for staying on with us. All right, moving from one conversation from a corporate voice to another. Nitin Rakesh is the CEO at Mphasis, and we've also got Manish Dugar, the CFO, joining in to chat a little bit more about their numbers. Good to have you on board, gentlemen. Nitin, to begin with, as you promised, it seems like growth has bottomed out. We did see the marginal gains kick in this quarter. Going forward, do you believe that growth will accelerate?
Yeah, I think if you think about the components of the business that were a little bit under revenue pressure for the last few quarters, I think we are seeing stability in most of those segments. There is still uncertainty in BFS, which obviously is the largest part of our business. But we do believe, based on at least the recent trends, there is some stability starting to emerge there. Still a seasonally challenged quarter, so we'll have to watch how that goes. But the other two segments, I think between mortgage business, we saw the pace of decline really coming off sharply last quarter. And we called with that fact that we are at or near the bottom. They are purely based on the order book and the market share gains. It seems like we should be able to see sequential growth. And we've seen stability in DXC already. So purely based on the order book and the wallet share, status of accounts, bottoms up, it looks like we should be able to see sequential growth, in the next 2 quarters.
Sure. Nitin, and this sequential growth would be despite the higher Q3 furloughs that your peers have been guiding as well, you think?
Yeah, I think some of that uncertainty still exists, especially in the BFS segment, as I called out. But given the fact that in the first half of the year, we've had 920 million of TCV wins, kind of a record for H1. Last quarter, obviously, was a big win quarter, being Q1. That also helps build the revenue base from an order book perspective for the rest of the year. So I think we're cautiously optimistic that we should see a return to growth. Acceleration of growth might happen, in the subsequent quarter, but definitely things are looking like they're bottoming out.
So Manish, give us a sense as to what the outlook is when it comes to the margin walkthrough. Do you stick by your 15.2 to 16.25% margin guidance, or are you revising it?
The philosophy has been in making sure that we remain within a sustained margin of 15.25 to 16.25 for the year while investing for growth. There are puts and takes. We have opportunities of investing, and at the same time, there are savings, that we have been able to accrue because of productivity gains, fresher mix, and so on. So as long as we are able to make sure that there is a focus on operating efficiencies and there is a focus on making sure some of these operating levers are maximized, there is enough tailwind that we see, which gives us confidence to maintain the margin in that range while investing for growth. We had called out that we are, reasonably confident of maintaining, if not significantly expanding, and we have been expanding the margin by 0.1% for at least the last 3 quarters. This specific quarter, again, revenue has been flat, and we are hoping as growth comes back, that itself will give us some opportunity for upside. But having said that, despite the last few quarters of revenue sequential decline, we have been able to manage the profitability. And given we are now getting revenue to bottom out, it only gives us an ability to either maintain, if not further expand from where we are.
Right. Nitin, your deal wins, though, have slipped sequentially and understandably because of the high base. What's the range that we should work with going forward, and which segments you think would contribute to deal wins given your diversification push?
Yeah, I think if you think about the nature of large deals is they're lumpy. We had an exceptional quarter last quarter. The good news is pipeline is still up 26% YOY. So our ability to continue to originate deals, is showing up in the pipeline. Obviously, every deal goes through a sales cycle, and given that we converted a very large number of deals last quarter, a record in terms of both number of large deals and TCV, I think it was bound to have an impact on the closure stage of deals. So as we build up the deal flow through the pipe over Q2, Q3, you'll actually see this number kind of revert to where we think the average is. And the average has been inching higher pretty much every year, for the last 5 years. So I wouldn't read too much into just the Q2 number itself, but I think if you look at the first half performance, it's actually significantly higher than first half of last year by over 50%. So the right way to think about it is trailing 12 months, and that I think from that perspective we are well positioned. If I then look at the shape of the pipeline and the deal wins, I think the wins have been fairly broad-based across verticals. They're not led by any one vertical. Non-BFS, both in terms of pipeline, has expanded very significantly, over 50%. Even BFS pipeline is up 25-26% YOY. Wins-wise, I think there's a pretty equal distribution, both in terms of Q1 and Q2. So I think it's a pretty broad-based view of both the pipeline as well as the TCV wins, and we're very pleased with the fact that while we're not deprioritizing BFS at all, because that's our home vertical, we have a right to win there. We continue to actually make sure that the diversification outside of that gives us new engines of growth, and that execution strategy has been working very well for the last few quarters.
Right. Manish, what about the headcount? Because there has been a slip sequentially. Do you think that this trend will continue?
As a philosophy, we actually have a continuous process of comp revisions through our GQ score and talent mix platform, and hence we don't have the once in a year comp increase that comes and hits the P&L. So it's a continuous process, and it happened last quarter. It happened this quarter, and it will happen in the next quarter as well. From a headcount perspective, a large part of our headcount is dependent on utilization, and as we have been working very hard to make sure our fresher engine starts kicking in, and as that kicks in, utilization improvement leads to ability to deliver revenue within the existing headcount. We have had a slight reduction in the overall headcount, however, from a productivity and a pricing perspective, and given deals are largely driven by outcomes, which does not necessarily have a impact of headcount, we have had not any significant increase in the headcount as the revenue has moved. But as revenues come back and as we start seeing growth, utilization can give us only so much. We will have some improvement possibility in the utilization. However, beyond that, it will eventually have to be supplemented with increased headcount. So, a lot of it depends on how the macro plays and how the revenues turn out to be. And as Nitin said, while we will see sequential growth, but we expect the growth acceleration, maybe Q4 onwards. And when that happens, we will have a better visibility of how the headcount plan will work out.
Right. Nitin, lastly, FY25 will be a year of inflection and turnaround for you after bottoming out in FY24. Would that be a fair assumption then?
Yeah, I think it's hard to call FY25 given the level of uncertainty on the macro front. This higher for longer narrative, the ability to see any improvement in volumes when it comes to things like mortgages, discretionary spend and budgets for next year, capital markets are still frozen. So I think it's very hard to call what happens, 6 months from now. At this point in time, given the uncertain macro, I think our focus really has been on the micro, which is go account by account, vertical by vertical, geography by geography, and start building out those order books that give us the visibility. Because the most dangerous thing in business is to call a bottom before you actually have certainty on it. So I think we are right now very focused on bottoms up approach versus trying to take a top down macro view. As we get closer to the next year budgeting cycle becoming visible in Jan-Feb timeframe, we'll probably get a better idea to give a guidance for FY25.
All right. Thank you so much, gentlemen, for joining in and giving us a perspective on the quarterly performance as well as the road ahead for Mphasis. That's the management saying that, yes, there is uncertainty about the extent of the Q3 furloughs, but the focus is going to be on efficiency as well as utilization, and the deal wins have been fairly robust. The pipeline looks strong. That's the stock price, though, down about 1.5% for Mphasis. But let's move right on then and put the spotlight on NMDC Steel as well, because you did have the Union Home Minister, Amit Shah, who said yesterday that NMDC owned 3 million plants, a 3 million ton steel plant in Chhattisgarh, and that is not going to go into private hands. Do remember, it was built at a cost of approximately 20,000 crore rupees. And NMDC's Nagarnar steel plant is a substantial investment in the steel manufacturing infrastructure. And on the back of that news, you've got the stock under pressure in today's trade, largely on the back of that kind of commentary. So down and out in trade for an NMDC Steel. Let's move right on then. Equitas Small Finance Bank in the spotlight. Let's understand a little bit more about the quarterly performance. There's been a sharp margin compression. Is there going to be a recovery or not? PN Vasudevan, the Managing Director and CEO Equitas Small Finance Bank, joins in. And I'm going to get straight to it, Mr. Vasudevan, talk about the margins, because earlier you had guided for 8.5% for FY24 for the full year, but it seems like you are seeing some pressure. What is the outlook on your margin guidance? Are you going to be altering it?
Good morning. Our interest cost, if you see, in the first quarter was 6.94%, and it was moved to 7.21 in the second quarter. And we had guided that the interest cost should end up for the year at around 7.5% by end of the year. So you can see that the interest cost increase over the next 6 months is expected to be moderate. Largely because most of the old deposits have got repriced now, and we are left with only a small part of the old deposit, which will get repriced at the higher rate of today. Correspondingly, over the last few months, we have also increased the lending rate on some of our loan products, and the benefit of that we expect to see over the second half of the year. Because it takes time for the increased rates to actually start impacting from an income perspective. A combination of these two, is what we expect that the NIM, which is at 8.45% for the second quarter, the exit NIMs for the year could be around 8.25 to 8.3. However, for the full year, on a full year averages basis, we still expect the NIMs to be in the range of around 8.5.
Okay, fair enough. So that's the outlook when it comes to your overall margin. What's the sense as well when it comes to some of the other parameters in terms of your overall growth guidance? What really has been aiding the growth so far, and your sense on whether or not this is likely to sustain? You are well capitalized, so does that mean that your growth guidance as well remains the same?
Yeah, on the growth part of it, as we have been informing before also, we are largely serving the underserved or unserved segments of the population, where there's a large amount of unmet demand for credit. So typically speaking, the demand from the market is generally never the issue for us from a lending perspective. And we are also well capitalized. We are at capital adequacy of in excess of 21%. So we expect that we should continue to be able to grow in the region of 25 to 30% over the next few years.
Give us a sense on, Mr. Vasudevan, where the unsecured book is like and what's the kind of exposure. Are you calibrating or going cautious on any on growth in any of your particular segments that you have exposure to?
In terms of unsecured, we are not into the personal loan market today. Our unsecured book is only the microfinance that we have been doing from 2007. And microfinance is contributing about 19% of the total advances as on date. We have always been saying that, we will continue to pare down the microfinance over a period of time. And, when we became a bank 7 years back, microfinance was as high as 53%. Over the last 7 years, it's actually come down to about 19% and replaced by all other loans, which are all secured, except microfinance. All other book is secured book. So we don't particularly see any concern in our unsecured book, which is our microfinance. You know the microfinance industry. Whenever there is an extra event or a market event or an external event, microfinance tends to get under some stress. But if there is no specific external event, microfinance typically tends to perform very well. And so last 1 year, actually, microfinance has been doing extremely well. And so we are really not having any concern from our unsecured book, which is principally the microfinance.
On the deposit side, though, Mr. Vasudevan, you've done pretty well. Is it just higher rates offered to customers or something else that you're doing differently?
You see, our interest rates on deposit definitely is higher than the large banks. But I'm just cutting back about a year and a half back to May 2022. The difference between our peak deposit rate and that of the large banks' peak deposit rate was around 2%. And today we have reduced that to about 1.5%. So nearly 50 basis points we have reduced the difference between our peak rate and that of the large banks. So over time, we have been trying to consciously reduce our interest rate on deposits. However, there is still that small increase compared to the large banks. And that's definitely an attraction from a depositor perspective, especially senior citizens. And almost half of our deposits, 45% of our deposits come from senior citizens, for whom that 1% plus does make a lot of difference. And we have been seeing a very strong traction in our retail TD, especially over the last 6 months. Our retail TD has grown very sharply. And second quarter, we saw an increase of nearly 40% on our deposits.
All right, fair enough. I also wanted to get in a sense as to what the outlook is when it comes to your credit costs, because those are benign. Are there any early signs of pressure that you're seeing or any buffers that you would look to build in at this point?
So that's a good story. Credit cost continues to be a good story for Equitas. Historically, we have been in business from 2007, so we have nearly a 15-year-old company come bank. And except during demonetization and COVID, which are external event stress created from external events, we have actually never seen a credit pressure on the company ever. So our underwriting norms, our method of sourcing the customers, we don't source through DSS at all. It's almost all of the business are sourced directly by our own staff. So the sourcing methods, the underwriting norms have been good enough, touch wood, that I believe that our portfolio quality should remain strong through, minus huge pressure created from external events. So long as we don't get that kind of stuff, I believe that we should continue to have very comfortable credit costs. It used to be in the range of 1 to 1.1% pre-COVID, and I think it should settle around that 1% to slightly lower than 1% going forward. Today it's about a 0.8%, so we are maybe it may go up by about 10 basis points over the next 1 to 2 years. But I think we are more or less where we are likely to be on a sustainable basis.
All right, good to know. And a quick word on your outlook on net interest margins. Is there any pressure? Do you think that you will maintain your margins?
NIMs, I had mentioned that slightly earlier. As I said, we expect for the full year, we expect to have a NIM, the full year average to be around that 8.5% level, while the exit NIM could be towards that 8.25 to 8.3.
Sorry about that. Yes, you had reiterated that in your first answer itself, 8.5%, and you will be looking to maintain that. Okay, good to have you on board. Thank you so much for taking time out and joining in. Let's shift gears. Time for Chartbusters. What's looking good on the charts? Naresh, Kunal joining right back in. So let's find out what they're picking out for the day. And Kunal, your Chartbuster call?
So that's on trend and how the stock has been showing signs of distribution or some sort of consolidation, which could actually result into the stock going into a downward spiral. Now, what has happened is the stock over the last 4 or 5 months have, of course, gone into a strong uptrend. But here on, the stock has been forming a topping out pattern, on the short to medium term charts. As you can see that the stock has been forming what we call it as a classic head and shoulder pattern, and the breakdown of this pattern is around this 2000 levels. So for the last 2.5 odd months, the stock has time and again just gone into this 2000 odd in territory, but has failed to cross over or cross below these levels. I believe that whenever the stock breaks below this 2000 mark, we could be looking at a sharper correction coming into the stock price. Almost the 200 points as an immediate correction is what I would anticipate for the stock price. So something to watch out for from a specific stock specific point of view. The stock showing signs of a topping out formation, especially around this 2000 mark, which could be a breakdown point for trend over the very short term time frame.
Okay, that's the take coming in on trend. Naresh, what's the Chartbuster you've identified?
So that's the chart for Hero MotoCorp. Now, if we look at the stock price, it has crossed the recent 52-week high, so a fresh breakout done here. But what is interesting is the amount of consolidation it had around that 2900 to 3000 mark. Multiple tops in that area from 2021 to 2023. Broke out above it, then we saw some bit of bad news, but did not break below 2900. Multiple attempts around 2900, 3000, and that held on. And now it seems a new trend has started. It's the first hit around that 52-week high, but eventually it could head up much higher. So it's an accumulate in the zone of 3100 to 3250. Eventually the stock could outperform, go towards 3600 to 4000 levels, a stop loss to be kept at 3000.
That's trend and Hero MotoCorp on Chartbusters. Kunal, what about individual stock ideas?
To buy calls, the first one is a buy on Railtel. The stock is showing signs of a breakout above 240 plus marks, so would suggest a target of 255, stop loss at 235. And the second would be a buy on Shriram Finance. That stock is also showing signs of some sort of support at 1800, 1850 levels. So targets of 1940, stop loss at 1850.
Okay, and Naresh, what about your stock specific intraday strategies?
So first is a buy on JK Paper. The stock has given a short-term breakout, continues to hold on in this market. Stop loss at 400, target price of 450. Second is a buy on CRISIL, a new 52-week high here, a range breakout above the 4100 mark. Stop loss at 4000, target price of 4600.
Okay, on that note, let's take a very quick break. Let's also revisit what the market has settled in at. Definitely a bit of a shake-off, but definitely not as bad as what you saw with the rest of the world and the global handover at that. IGL is now down 10.5%, MGL down 7%, ABFRL, Emphasis, Interglobe Aviation, these are your key pressure points from within the mid-cap end of the market. ITC, by the way, has cracked 2.25% as we speak right now. IndusInd Bank also down about 2%. So on good numbers also, you're seeing some profit taking kick in. There's Techem, HDFC Live, JSW Steel, DRL. These are some of your other big drags from within the large caps. We'll take a break, lots more on the other side, so do come back.